This is Zach Peterson here with Sutton Premier Realty, and today we're going to be talking about the Vancouver housing market and how it's been affected by different government regulations lately, British Columbia and investment opportunities elsewhere in the province, including Vancouver Island, as well as the booming Ontario market and the slow Alberta market, which has been greatly dampened by the decrease in oil prices. We'll also be talking about some of the best cities to invest in the United States and what kind of effect Donald Trump is going to have on the real estate market. This video will give you a good idea of what you can expect in the real estate market in 2017. Across the Metro Vancouver and Lower Mainland housing market, we've noticed a steep decline in sales as a result of government intervention that was acting on an already declining market. It is widely believed that the Vancouver housing market had already peaked in April of 2016 before the foreign buyer tax and the stricter mortgage regulations were even introduced. And it looks like we won't see a further increase in prices until late in 2017. Now, if you think the Vancouver market has crashed and prices are going to become affordable in the near future to the local buyer, think again. It currently takes 60% of a Vancouverite's income in order to cover the financing of the mortgage on the average Vancouver home. So considering that banks judge affordability based on 30 to 35% of the buyer's income, don't expect this to happen anytime soon. Vancouver homes have been unaffordable for the past 25 years, and considering that home prices haven't dropped despite the lack of sales due to a lack of listings, there are no signs of that changing. The housing market in Metro Vancouver and the Lower Mainland has developed a massive gap between affordable condos and townhouses and the unaffordable detached single-family home and luxury real estate market. Watch for condo and townhouse sales to remain strong as the detached home market continues to feel downward pressure. If you're investing in Vancouver, remember, cash flow is king. So if you have any negative cash flowing properties, you should definitely consider selling those now. In BC, we can expect to see a massive migration of people into the province from other provinces like Alberta and Saskatchewan, where a lot of people have lost their jobs. This is a reversal of a trend that started 4 years ago. In 2016, BC saw the largest recorded growth in the third quarter since 2009. In 2017, you can expect to see further growth of immigration levels, particularly into the Lower Mainland. Currently, the best opportunity for investors in the Metro Vancouver area and Lower Mainland is for those with excessive cash who can take advantage of the high-end luxury housing market on Vancouver's west side. The foreign buyer tax and ban on assignments or shadow flipping has taken a lot of momentum out of this market, but due to the maintained desirability of these properties, they will lead the way in the spring when the market picks back up again. For any investors looking to take a chunk out of a motivated seller and score a massive kill, early 2017 is the time to start hunting. The Vancouver townhouse and condo market will remain stable, with transit-oriented developments and retirement communities being the prime focus of real estate opportunities in the Lower Mainland. Transit-oriented developments are mixed-use developments that combine residential, industrial, manufacturing, and retail into a condensed area of living space and work. These developments allow home buyers and tenants to put their cost savings towards buying better homes and paying higher rents. Some of the best transit-oriented communities will be found in Surrey City Centre, Burnaby, Metrotown, and the Tri-Cities area. Surrey City Centre will provide affordable housing and rapid transit to Vancouver, Burnaby, Richmond, and New Westminster via the SkyTrain. Also, the City of Surrey announced a light rail transit network that will connect Surrey City Centre to Guildford and Newton. This is great news, and you can expect a bump in prices along the LRT pathway. Combine this with the academic district containing numerous training facilities such as Simon Fraser University and Kwantlen Polytechnic University, all within the transit network, and Surrey City Centre is primed to be one of the best investment opportunities in the Lower Mainland. Also, in Fleetwood Town Centre, a new plan has been approved to boost density around the Fraser Highway and 160th area. This change in zoning will allow for construction up to 6 stories. In Metrotown, which is already fueled by upzoning changes, they're on the fast track to receive further increases in zoning that will allow for up to 12-story multifamily residential building on the east side of Central Boulevard, with slightly less density on the west side of Central Boulevard. Also, in the Joyce-Collingwood area, the City of Vancouver has approved rezoning for a 2-block radius around the SkyTrain station. This will allow for 4-story apartment buildings and townhomes. In the Tri-Cities area of Coquitlam, Port Coquitlam, and Port Moody, Coquitlam staff is recommending higher density zoning in an area which has already seen massive redevelopment around the Evergreen SkyTrain station. The arrival of the billion-dollar Evergreen SkyTrain extension in December of 2016 brought with it a massive lift in investment potential in the Tri-Cities area. The Tri-Cities are a great opportunity for long-term buy and hold investors, with the best investments being detached homes in central areas with secondary income suites. These detached homes with additional rental units provide dual stream of income and appreciation factor that is much stronger than the townhouse and condo market. They may also benefit from increased demand from developers if they are located in the right spot. This area can also expect to see a big gain from the first-time buyer incentive of matching down payments from the provincial government. Other areas to consider in the Lower Mainland are South Delta and East Vancouver. South Delta will see the Massey Tunnel replaced by a $3.5 million project crossing the Fraser River, completed in 2023. This will increase travel times in and out of the city. Anytime you make it easier for people to go from point A to point B, you're increasing values in that area. Also, the median detached house price in South Delta has fallen by nearly $300,000 from its peak to just over $1 million now. The objective here is to buy houses before the movement of retirees into the area over the next few years. South Delta, being without the foreign buyer tax and the largest enclosed mall in Canada being opened in Tawasin in December, means foreign buyers will be looking to invest and further increasing property values. East Vancouver is a prime landlord destination even despite the high cost of entry. Even with the tightest vacancy in Canada, cash flow may be hard to come by, but that is far offset by the potential value increase of the property. The average price per door is up 45% since 2015. Don't expect to see the double-digit price increases we had in 2016, but these are areas that show the most promise and can expect to hold their own and bring returns in 2017 and beyond. The introduction of new mortgage qualifying restrictions in October 2016 has definitely put a damper on the Canadian real estate market, making it nearly impossible for first-time homebuyers to qualify for a mortgage. Even if your mortgage will be for a lower variable interest rate, buyers must now qualify at the 5-year fixed rate, resulting in a reduced borrowing power of around 20%. It almost seems as if the government is blaming first-time buyers for the rising real estate prices, which doesn't make any sense. The new mortgage rules are also putting condo investors at a massive disadvantage to the big multifamily investors who aren't affected by the new mortgage qualifying restrictions. These multifamily investors are able to get insured commercial mortgages at low financing rates. Due to the expectation that these regulations and underwriting practices are going to continue to increase, I would highly recommend that you lock in your mortgages and refinance now, especially on investment properties. Don't worry about getting the best rates, just worry about getting your mortgage application approved in writing, because it will be much harder to get financing in the future and you may not be able to qualify. Most banks are already limiting investors to 5 properties, and don't be surprised if they cut that number down to 3 or 4. Once again, the greatest threat to the Canadian real estate market is proving to be government intervention. Also, fixed rates are expected to rise slightly in early 2017 due to increased government intervention in October of 2016. And also, an upswing in bond yields caused by the Trudeau government overspending by nearly double. It is not expected, however, for the prime rate in Canada to change throughout 2017. even though the US will likely be raising their interest rates by the end of the year. Foreign buyers have been inching their way back into the Metro Vancouver and Lower Mainland housing market ever since the foreign buyer tax was introduced in the summer. In fact, they may have never left, and their presence may be stronger than most would have you believe. What has changed is they started to use corporations and trusts to disguise their purchases of Metro Vancouver homes. The 15% foreign buyer tax does not apply to permanent residents or foreign nationals who set up a company in BC, as long as no more than 25% of that company is owned by offshore shareholders. With increased restrictions on the outflow of capital from China, and the thought in everyone's mind that the EU could collapse, and with it the euro, a lot of European, Middle Eastern, and Asian money will be finding its way to Canada. Canada is a stable and secure real estate investment market that is second to only the US and Germany. Foreign investments will likely continue to flow into Canada and further increase real estate prices. Many experts are speculating that foreign investors looking to avoid the 15% foreign buyer tax, who are uncertain about investing in other cities such as Toronto and Seattle, will be pushed into the commercial sector in and around the Lower Mainland, which is not subject to the tax. They can also save a considerable amount of money by buying a vacant lot zoned for residential housing, pay the foreign buyer tax on a much lower price tag, build on the lot, and almost entirely avoid the tax on their purchase. For investors in BC in 2017, land should be the foundation of your investment strategy. It doesn't even have to be in the big cities of Metro Vancouver and the Lower Mainland. There are development sites in other areas such as the Okanagan and Vancouver Island, which may be able to provide you with excellent returns. Look for development sites in areas with strong population growth, especially retirees, young tech workers, and government employees. According to a new study by Insights West, 34% of Vancouver homeowners say they are considering selling their property to move to a more affordable market in the next few years. We expect that the homeowners most likely to move in this group are those nearing retirement who have experienced great appreciation in the value of their home and are looking to move to a quieter part of the province where prices have remained low. Some of the top retirement towns in BC are Summerland, Kelowna, Sydney, Sechelt, Comox, and Parksville. The best landlord markets in BC in 2017, in no particular order, are Kelowna, New Westminster, Abbotsford, and Victoria. Kelowna is the Okanagan's biggest city and has emerged as the center for the technology, advertising, media, and information sector. This sector is responsible for employing hundreds of millennials and has helped Kelowna achieve one of the lowest vacancy rates in Canada. Builders are scrambling to supply single-family homes and condos to eager renters who have been held down by the recent change in mortgage qualification standards. Due to the rising home prices, it is unlikely that any of these renters will be able to buy anytime soon. With 3 SkyTrain stations and new rapid transit into Coquitlam, New Westminster is at the center of Vancouver and becoming high in demand for rental units. The population of Abbotsford is growing quickly, resulting in a strong and stable rental market. Vancouver Island housing sales are expected to increase this year and into 2018. The unemployment rate is second only to the Lower Mainland, and it is projected that Vancouver Island will lead the province in job creation in 2017, just ahead of the Lower Mainland. This is a great sign for the market, as the rest of the province has seen negative employment growth. This growth is partly led by the tech industry, which currently employs 23,000 people in Victoria, and in Nanaimo, which is the 4th largest tech industry in BC. People go where the jobs grow, and values grow where the people go. A migration of people to Vancouver Island will boost the already growing population in Victoria, Nanaimo, and Comox. Victoria represents one of the best landlord markets in the province, if not Canada. The rental vacancy rates are so low that they are actually at unhealthy levels. This rental demand comes from students, employees in the tech sector, and seniors. With the low Canadian dollar and no foreign buyer tax, Victoria will likely become the next big real estate opportunity in BC. While Victoria looks more expensive to Victoria residents, it's at a significant discount to Vancouver, and many homeowners may be looking to downsize and move to the island for retirement. Watch for talks of a foreign buyer tax in Victoria, as councillors have already started thinking about the idea of applying a foreign buyer tax to the capital region and possibly even imposing a vacant property tax. Next, let's talk about Ontario. It appears that a lot of money has fled Vancouver due to the foreign buyer tax and ended up in Ontario. Ontario sales have continued to set records despite an unprecedented supply shortage in the Greater Toronto Area and surrounding regions. With no foreign buyer tax, a huge inflow of foreigners, and a strong first-time buyer base, Toronto is recommended the #1 city in Canada to place your investment capital. Because of the lack of listings resulting in multiple offers and sales well above asking price, many people are calling for a foreign buyer tax to be brought into Ontario. Many forecasters are predicting that the tax will be slightly lower than what we have seen in Vancouver, maybe around 10%, and it will be more selective and not retroactive. Other areas in Ontario to consider investing: Mississauga, Hamilton, Guelph, and Kitchener. Now, moving on to Alberta. Alberta is in a rough start to 2017, but there may be some buying opportunities in the condo market from developers who are being stressed by the glut in the market, particularly in Calgary or Edmonton. CMHC says about 1,500 newly built housing units sat vacant across Calgary last month, and more than 800 of them were apartment-style condos. Calgary hasn't seen this kind of new build vacancy in over 15 years. If you are considering placing investment capital into Calgary or Edmonton, look for waterfront properties targeted at rich foreigners and throw out some lowball offers to test the motivation of the developer. While it may be a bit harder to find tenants at this time, you may get the deal of a lifetime with the developer throwing in incentives like a car, furniture, or mortgage buy-down just to enable to get you to close on the deal. If you are buying a place to live in Calgary or Edmonton, look for properties with good investment potential and buy as much home as you can afford while negotiating the best possible price for yourself. For the most part, as an investor, we recommend that you stay on the sidelines unless you can truly get that deal of a lifetime. It looks like Alberta will be held down until oil starts to make its way back up again. The Canadian dollar may show some short-term strength in the early to mid part of 2017, but with the possibility of Canada cutting their interest rates further and the US raising theirs throughout the year, look for the Canadian dollar to drop similar to the lows of last year. If we do see a short-term strength in the Canadian dollar, take this as an opportunity to load up on US dollars. Many forecasters are predicting that the Canadian dollar will follow a similar trend to the price of oil, with one caveat. If the Trudeau government has any more surprises with the handling of our nation's debt, we could see a further downgrading of our currency. With crude now sitting around $50 a barrel, and OPEC having voted to cut back production, it looks like oil will be heading lower into the $40 range in the beginning of 2017. This is a good sign to stay out of oil-producing states and provinces, just in case OPEC decides to cut back production even further. For investors, it is important to understand what our currency is doing, especially when you're considering investing in the United States. If you invest in the US and the Canadian dollar rises, you lose. If you invest in the US and the Canadian dollar goes down further, you win. For the time being, you must have a really compelling reason to invest in US real estate. Otherwise, stay at home and invest with Canadian currency. It's just one less thing to worry about. It looks like the US will be raising interest rates several times throughout 2017, resulting in a lower Canadian dollar. This should be noted by Stephen Poloz, who has continued to devalue Canada's currency in order to make Ontario's manufacturing industry more competitive in the global market. Devaluations just don't work. Canada is already competitive with our largest trading partner, the US, because of our lower Canadian dollar. There was no need to decrease interest rates further and devalue our currency by an additional 30%. In Stephen Polo's mind, exports should be growing right now, but in actuality, All that has resulted in is rising real estate prices and increased household debt. This devaluation of our currency and excessive drop in interest rates has caused real estate prices to skyrocket, inflation like crazy, and a massive buildup of household debt because financing is so cheap. The lower dollar is doing far more harm than good. Our economy is in a free fall. The US looks to be continuing on with a strong economy leading into 2017. With 360,000 jobs being created, that's more than the rest of the world combined. This is its best employment picture since 1999. The top US cities to buy in 2017 will be Seattle, Phoenix, Portland, Tucson, and Las Vegas. Seattle leads the list, but watch for Tucson to take up a portion of the Arizona market in 2017. With Trump's promise to increase defense spending, Seattle's already strong economy could benefit greatly from this boost. Currently, half of the expensive homes being sold in Seattle are to Chinese buyers, which is compared to 30% before Vancouver introduced the foreign buyer tax. There's already talk of a Seattle bubble, but Washington's biggest market is going to surprise most in 2017. Moving on to Phoenix, unless President Trump proceeds with his promise to build a wall along the Mexican-US border and deport millions of illegal workers, the election will be barely noticed in Phoenix's booming real estate market. Next up is Portland, which remains the most affordable, large metro area along the United States West Coast. Oregon has strong job and population growth and benefits greatly from large population inflows from other states. With some of the lowest vacancy rates in the country and stringent constraints that restrict the development of the area, Portland should continue to be a winning investment for years to come. Also, as mentioned before, you'll want to keep an eye on Tucson and Las Vegas, as well as San Diego and San Francisco. The question on a lot of people's mind is, what effect will Donald Trump have on the real estate market during his presidency? Well, let's look at some of the pros. There could be less regulatory land use and zoning restrictions for housing construction. He may invest heavily into infrastructure, which means thousands of jobs throughout the country. It also means that concrete, housing, commodities, and businesses will benefit. He likes coal, so coal-producing towns could see a bump. Real estate assets along the Keystone Pipeline could see a benefit. Cutting taxes and running a huge deficit means more jobs and higher inflation, which is always good for hard assets like real estate. His investment into the military will benefit the real estate in military towns and where the factories are located, and most likely the US dollar will rise. Now, let's look at some of the negatives. The additional spending will raise interest rates faster than expected. His protectionism and trade deals may upset some countries such as Canada, who benefits greatly from trade with the United States. Trump's promise to deport 11 million illegal workers could have a dangerous impact on America's already tight labor market. Most importantly, it will empty a lot of C-class buildings in places like Arizona. When Arizona deported Mexicans in 2011, entire apartment buildings were emptied. And lastly, he could possibly default on the country's debt. He mentioned it, but actually doing so is very doubtful. But on the other hand, he is Donald Trump, so this wouldn't be the first time that he went bankrupt. Next, we get to talk about one of my favorite parts of real estate investing, which is buying vacation properties. One of my goals in life is to buy vacation properties throughout the province and rent them out while I'm not staying there, allowing me to stay there for free on my vacation. Here's a few select ski resorts that have the potential to double as investment properties and also provide you a wicked place to stay on the weekend. In Whistler, buyers who use the US currency to do their business are arriving in full force thanks to Canada's discounted currency. With the owners of Vail Resort in Colorado recently purchasing Whistler, it has been hit with a number of factors that are resulting in increased real estate values. Some of the biggest being the aforementioned discounted Canadian dollar and the fact that there's no 15% foreign buyer tax there. Whistler has also developed a strong summer market that attracts tourists for a number of different activities, all within the resort. Whistler is rated as one of the top 5 places to go mountain biking in the entire world and also holds massive events such as the Ironman and Tough Mudder. You may have missed the deal of a lifetime in Whistler, but you'll be happy to know that this market has a long road ahead of it and there's still an opportunity to get great returns. Plus, who wouldn't want to own some real estate in Whistler? Next on the list is Sun Peaks. Sun Peaks is the second largest ski resort in BC and has over 4,000 skiable acres. Second only to Whistler in size, it comes at half the price. This top-rated ski resort also has a challenging 18-hole golf course, which makes it a very versatile winter and summer combination. Next, we'll have a look at Big White. Big White is the largest night skiing resort in Canada and the third largest ski resort in BC, with nearly 3,000 skiable acres. Prices are lower now than they've been in years, and you can get a studio apartment for around $89,000. Only a few hours away from Vancouver, Big White is a great place to consider if you are looking to invest where you play. Alright, well that about wraps up this video. Hope you guys got a lot of good information. And if you guys have any questions, just drop it down in the comments section below, or feel free to call, text, or email me. And don't forget to hit the like button.